Good morning, ladies and gentlemen. We are live, we are live, we are live. We are broadcasting live the Altron annual results here from Investec. And it is my pleasure to be your host this morning. I'm Bronwyn Nielsen. I'm joined in a moment by the CEO of the Altron Group, Werner Kapp, and the CFO, Karel Snyman, to present your results this morning. And we'll be following that with a Q&A. So if you do have questions, please reserve those for the Q&A. Of course, we do have online viewers this morning, and you can also post your questions in our chat box. As we are live, please make sure that your cell phones are also off at this juncture. Aligned with our values of inclusion, our results will be interpreted at this stage on behalf of the deaf community, and that will be on our live stream this morning. As a reminder, we will be making forward-looking statements. Please look at the cautionary language in our presentation, and that's regarding the risks and uncertainties when it comes to those forward-looking statements. Unless otherwise noted, all growth comparisons relate to the corresponding period last year. On that note, Werner Kapp, the CEO of the Altron Group, to you, sir.
Thank you very much, Bronwyn. And thanks everybody for joining us here today. It's amazing to be able to do these results live, I think for the first time since COVID. I'd really like to thank our board members for attending. There's a number of our group MDs here, and of course shareholders, and then particularly to Investec, our sponsor, for hosting us today to take you through our results for the year ending February 29, 2024. Now, Altron is the original South African technology brand. We've been around for 59 years. We started on 1st of April 1965, and since then, we've really been combining technology, South African ingenuity, and more recently, the advances in data and artificial intelligence to really help solve real-world problems on behalf of our customers and make an impact on the economy. This really informs our purpose. This is what gets us up every day. It's what motivates our staff when they're in the trenches every day. And that is to use technology to transform today into a simpler, safer, and smarter tomorrow. And we put this to use every day, helping South Africa's biggest brands to take on tomorrow. So this is the results presentation. So I hear you say, that's great, Werner. How does that ultimately impact the numbers? So let me take you through our financial highlights. Just want to remind you, we look at the business from continuing operations, which is really the businesses that we're focusing on investing our capital in, and then from a group perspective, where we've got our two discontinued operations in Altron Nexus and ADS. Also, just a reminder, on the 1st of July last year, we sold our ATM business. We generated 216 million rands worth of cash from that, and really to be able to give you a good like-for-like comparison of how the business is doing, we've removed 4 months worth of contribution from that business from the numbers that I'm about to present to you. So I'm really proud to say that our strategy execution is leading to some strong underlying performance by our core operations, evidenced by 18% revenue growth, 27% EBITDA growth, 33% growth in operating profit, resulting in a 36% growth in headline earnings per share and 46% growth in EPS. Especially pleasing for me is that cash generated from operations are up by 25% year on year. I'd like to take this opportunity to really thank the 4,400 odd people that work for Altron, along with the leadership and management team that work with me every day for the results that you are seeing here. If we then look at the group, you may recall at half year, we took some provisions to the tune of about 462 million rand relating to our Altron Nexus and Document Solutions business. 33 million rand of that was impairment at group for the Nexus goodwill, 334 million rands worth of provisions related to Altron Nexus, and 95 million rands worth of provisions related to the Altron Document Solutions business. So at a group level, that negatively impacts our results. And these numbers are tough for me to present, because some of the decisions that we've made there and the provisions that we've taken, to some extent, really offsets, the fantastic work that I think we're doing in our continued operations. Revenue is up 3% year on year. At a group perspective, EBITDA up by 1%, operating profit down by 30%, and negative HEPS of 25 cents per share and EPS of minus 43 cents per share. But As you can see, and I'll take you later through some of our discontinued operations, because of the good work we've done and the strengthening our balance sheet and really being able to drive our continued operations going forward and improving our cash by 25%, we decided in FY24 at half year to raise our dividend payout from 40 to 50%, and I'm very proud to declare a final dividend of 33 cents per share, which is up 74% year on year. So let me just take 1 or 2 minutes just to take you a little bit through the strategy and the journey that we're on as a business. Our strategy is to become the leading platform and IT services business in our chosen markets. And that strategy really has 3 key growth levers for us. The first one is to grow revenue by maximizing the value that our customers get out of their digital spend. The second one is to improve operating leverage, and that's by managing our gross margins better and making sure we've got a good handle on our expenses. And the last one really is to drive transformative growth. That is by continuing to drive our continued operations. That is to really leverage and continue to leverage the power of data and AI, both within our organization and for our customers. It is to expand our platform ecosystem to get more network effects, and through judicious capital allocation to see if there are M&A opportunities in the market to bolster our capabilities or to expand geographically. This strategy is enabled through efficiently allocating our capital, differentiating through collaborating. So that's really about how we show up better as different businesses with our customers to make sure that we can able to do the kind of things that these case studies talk about, and developing a high-performance culture. And if we execute on this strategy, we make sure that we deliver our short, medium, and long-term goals. What's also, of course, very important is that we remain obsessed with our customers at all times, and that everything we do is not harmful to the environment, that we adhere to sustainable business practices, and that we hold ourselves to the highest levels of governance and ethical leadership. What's really pleasing is to see that this strategy execution is starting to drive performance. As you can see there, a 5 percentage point improvement in gross profit from a year-on-year perspective, 11% growth in gross profit. We see that flowing through to expanding EBITDA margins. Very pleased with an operating profit margin growing 2 percentage points year on year from 7 to 9%, ultimately leading to us being able to grow our earnings over time, with headline earnings increasing 37% year on year, now growing by about 46% compound over the last 4 years. Also, a big focus on cash, and Carl's going to take you through a lot of the detail around that later. A 28% reduction in working capital, which is leading to improved group cash flow generation, about 25% improvement in our cash generated from operations on a year-on-year basis. And very pleasingly for us, a 6 percentage point improvement in ROIC as a result of that, to a point now where our ROIC is now comfortably above our weighted average cost of capital in the business, which is a big focus area for us. So let me just break down a little bit more detail than the operating performance in our different businesses, starting with our own platform segment. As you know, we embarked on I was glad to see Julian, one of our key customers, referring to that. We really made some changes in the Netstar business and refocused on our customers, on some key operational efficiencies, and also investing in our big data as a service. And you may have seen the launch of our Global Fleet Bureau recently. It's really great to see some of those numbers coming through. Growing market share by adding 370,000 net new subscribers this year. We're now at the 1.7 million rand subscriber, which is about 27% growth year on year, driven by 14% growth in our consumer business and 33% growth in our enterprise business. You may recall that we spoke about some key operational efficiencies that we had to address in the business that was impacting profitability, notably our contract fulfillment ratio and then our pre-fit conversion rate, which is really around converting the devices that we fit on the dealer floor into revenue. That was a big drag on earnings in the past. And as you can see there, that we've managed to improve the contract fulfillment ratio from 72% to 94%, and the pre-fit conversion ratio from 32% to 66%, whilst expanding our fitness center partnerships to be able to grow the business so we can turn that subscriber growth into revenue and profit, and of course be able to deliver that service to our customer. Whilst we're doing this, we've also launched 5 innovative new products in the market. Our NB IoT device, the 590 device that Julian referred to in the case study. StarTag, which is really quite an innovative device which helps us to completely revolutionize the way we tag mobile assets. We've done some specific tracking devices for the Australian municipality market, and of course our CAP solution, which is really aimed at the mining segment. And really proud about the launch of our Global Fleet Bureau. We believe that it is the most technologically advanced and largest of its kind on the African continent, which really leverages artificial intelligence and machine learning to add value, not just to our enterprise customers, but also to be able to serve our consumer business better. I mean, here's a really good case study for you. So Putco had a really large tragic accident that claimed a lot of lives. And then they started using our network fleet management system. And more than just simple tracking of buses, they also use it to monitor safety, using particularly the advanced analytics that we've got around driver behavior. And by using this, they've been able to drastically reduce the accidents as well as the claims that have been recorded against them. So you can really see that profit momentum being powered through all of this. I mean, scaling our business through a number of key technology partnerships. We've launched with Microsoft an industry-defining architecture for telematics on Copilot. We've extended our strategic OEM partnership with Toyota further into the Southeast Asia market. And this has really driven some good revenue for us. Really pleasing to hit the 2 billion rand revenue milestone, 12% revenue growth there, and 27% EBITDA growth. And as you can see, there's also a significant improvement in our EBITDA margin, about a 4 percentage point improvement in our EBITDA margin year on year. I'm really, really pleased, and I really want to thank the Netstar team for all the hard work that they've done, and I'm really pleasing to see that it's starting to yield some good early results for us. If I now turn to our fintech business, this is our second biggest business from an EBITDA perspective. I mean, really just to remind you that there's 4 business units within this business: the credit management solutions business, the payments and collections business, the integrated transaction solution business, and the cards personalization and issuance business. And there we've given you just an indication of the contribution that they make to the overall revenue of the business. What we try to do here in the next slide is also just to give you some insight into what really drives the numbers in these different businesses, and I'll take you through it now as I take you through the results. So if you look at the credit management business, 19% improvement there in revenue, and that, as you can see, is really driven at the top by a significant increase in credit inquiries as well as an increase in the loans processed. 12% increase in our collections and payments revenue business. Debit orders, they're fairly flat year on year, but as you can see, a significant increase in value of the debit orders being processed. Just to remind you about our integrated transaction solutions and our card and personal issuance business, I mean, we guided in FY23 that we've had some abnormally high hardware sales. So this business, like most businesses, has got a technology, hardware, and annuity component to it, and that can be quite cyclical. It can be based either on key customers' CapEx cycles or also on industry-wide technology upgrade cycles. So our revenue in both businesses, as you can see, is down as we guided that it probably would, but what's really, really encouraging for us there is, as you can see, again, the annuity business growing. Devices being maintained up by 27%. As you can see, volumes are up, and again, the values being processed being up in both of these businesses. And that's a key strategic driver for us, because in the fintech business, what we've managed to do is grow annuity revenue from 70% to 74% year on year. And I'm really delighted by this performance. 5% revenue growth, 22% EBITDA growth, when we've managed to expand our EBITDA margin by 4 percentage points from 26% to 30%. This is a highly specialized, highly cash generative, very high EBITDA margin generating business. And I really want to thank the fintech team for all of the work that they've done to deliver these results during FY24. If I now turn to our health tech business, now just to remind you, the health tech business really has 3 components to it. That is our private practice, our core private practice management system. We've expanded that system really into corporates. I mean, occupational wellness and health has become a big issue for companies to manage. And then also our switch business. We've made some significant investments, as you can see on the right there. Is it the right of your screen? Yeah, on the right of your screen, in that platform to not just future fit the business, but to really expand into new areas of growth. And that is starting to pay off. We see the corporate business has grown 9% year on year, and our private practice business is up 6%. 25% logos were added in the corporate business, and as you can see, there are 2,500 net new practice management customers. And a key leading indicator for us in that business is the amount of customers that we add for every customer that we churn to. So really pleasing to see that at 1.8 customers for every customer churn, leading to revenue growth of 7% and EBITDA growth of 3%, just to note, which was impacted by a planned 22 million rand expensed investment to drive that platform going forward. Again, a really high EBITDA margin, highly cash generative, sticky business with about 95% of its revenue in annuity. And I'd like to really thank the health tech team and all of their people for a very good performance during FY24. You saw this case study on video. Just to give you an example of some of the stuff that the business is doing and some of the investments we've made. Our Health One Oncology solution, what it really does is it really supports the entire value chain. The cost of cancer treatment in South Africa can be up to R1 million per patient per year. Now, you can imagine the psychological, the physiological challenges the disease puts you through, the burden it puts on the family. And what this oncology solution really do is it helps to alleviate that burden of care and also help drive down the cost throughout the value chain. The next step for us in this process is also now to use more advanced data and artificial intelligence to actually just manage that whole journey that the patient goes through and develop a patient app which kind of flips the system a little bit because the burden on the patient to manage these treatment protocols really is significant. All right, so let me turn to our digital transformation business. Now, I just want to remind you, we made a decision to integrate our Altron systems integration, Carabiner, and managed solution. So for the year past, we're reporting on the old segments, but going forward in our IT services segment, we will be reporting on Altron Digital Business, which we launched on the 1st of March, 2024, and Altron Security. The reason we did this is we really wanted focus and integrated sales. I mean, these are three good businesses with good solution sets, but we really have an opportunity to cross-sell, upsell, and drive annuity sales into our customer base. There's obviously opportunities for operating leverage and also for transformative growth to shift revenue to higher margin annuity-based services. If I start with Altron Systems Integration, this is a business that went through some challenges. You may recall we put a profit improvement strategy in place. Revenue growth is muted, but that was intentional, particularly because there was some non-profitable business that we exited. We managed to drive up gross profit by 16% on the back of a 3 percentage point improvement in our gross margins, and we reduced our operating expenses by 13%, leading to a 2% growth in revenue and a particularly pleasing growth in EBITDA, going from 5 million rand to 93 million rand, and I think you can see a significant curve there and an uptake in the profitability of that business. So I'd once again also really like to thank that team. It took a significant amount of hard work to get us to this point and really position us for growth going forward. If I turn to the Carabiner business, I'd be lying if I told you that I wasn't slightly disappointed by the revenue growth in this business that really delivers high-value services to customers. I mean, there were some extenuating circumstances, but I think it also just supports our case to put this in as part of the digital business to be able to drive revenue going forward. Having said that, I think the team did a fantastic job by changing the margin mix. You saw there a 9 percentage point improvement in gross profit margin, which led to about a 31% improvement in gross profit. So along with tight expense management, on a 3% revenue growth, we managed to deliver 14% growth in EBITDA and expand the EBITDA margin from 12 to 14% in the business. Altron Security had a disappointing year. For a business that really has high value IP that we bring to bear for our customers in this key growth area of digital identity and encryption, this is a disappointing result that we're not happy with. Number of reasons. There were some CapEx cycles with some of our key customers, and we had some challenge in our project services, but that's not good enough. Those are not the standards we hold ourselves to. We've put some corrective actions in place to fix this with the team, which is really around a more focused sales approach, tighter management routines in our project services, and of course, tight expense management. It is probably worth calling out that in the project services in this business and in all IT service business, you can make two decisions. If you see some constrained pipeline or deal conversion, you can let the people go. We decided intentionally not to do that. These are highly skilled people, and we are positive about the prospects of this business going forward. So we want to make sure that we hold on to those skills that differentiates us. As you can see, a high annuity business. So even though we had muted revenue growth and a disappointing 3% decline in EBITDA, we were still able to deliver 101 million rand worth of EBITDA at very high EBITDA margins for the year. From our Altron Digital Business perspective, here's a really good case study of how we were able to help Hungry Lion with our workforce management solution. So what we were really able to do with this is to help them analyze and scale their workforce. I mean, it used to take them about 4 hours a day to be able to do this. We've driven that down by 75%. We've also driven down the overtime in their business, and they are able to continue with their expansion of stores with a 0% increase in payroll. Right, let's turn to managed services and other. The managed services business, again, you'll recall that's where the NCR business came out of and delivered a pleasing performance for us in FY24. 9% like-for-like revenue growth with a 6% growth in EBITDA, delivering 54 million rand EBITDA for us in FY24. And I really want to commend the managed solutions team and thank them for their hard work to deliver this type of performance, particularly during a transition time as you take out a part of the business. Lastly, turning to Arrow, yet another exceptional year by a really exceptional management team. As you can see there, record levels of revenue for us coming on the back of robust revenue growth. Previously, 18% revenue growth. We've had margin growth. We've had very strict cost controls in that business. We've really improved our working capital management, and that has led to an exceptional performance of 33% EBITDA growth for us year on year. And as you can see, also a percentage point improvement in EBITDA. So really well done to the Arrow team and all of their people for an exceptional FY24 performance. Turning last to our operating performance in our discontinued operations. We took really decisive action in both of these businesses. In the ADS business, as you know, that sale fell through. In the Nexus business, we lost significant up to 50% of our revenue because of the loss of the Gauteng broadband contract. We hired new management, we've implemented target operating models, and we are making sure that we manage these businesses for value during this disposal process. Altron Document Solutions, I think that turnaround is progressing well. The team is doing a significant amount of work. There's very strict working capital management in that business. The business is now generating positive cash flow. It's actually started to pay back some of the group loan, and most importantly, it made a significant profit contribution for us in H2. So I'd like to thank the team again for the tireless work that they've put into turning around this business for us. Nexus, probably the most disappointing part of our FY24 performance. On the back of some of the provisions we took, we also made a trading loss, really as a result of losing 50% of your revenue, the time it then takes to take the necessary actions and restructure the business around that, which was slightly compounded by us on top of the restructuring costs, also by some delays at port, so we couldn't get some of our infrastructure out there to build. Biggest challenge in that business is you go from a high annuity base to a low annuity base. Having said that, even though the turnaround is a bit later, the new management came in later in the financial year. They're leaving no stone unturned. There's a lot of focus in this business to turn it around. I'd like to thank them for their efforts, and this business did not consume any group cash in H2. And I think, Carl, now it's over to you to take the audience through a bit more detailed financials.
Thanks, Werner. Morning, everybody. So just before we get stuck into this, I just want to make the point again so that everybody's aware about the ATM business that was only in our results for 4 months this year versus 12 months in the prior year. So what we've done here, we've given you the numbers as reported, and then we've given you the numbers excluding the ATM business on a like-for-like basis. Before we get into the detail, I'm very pleased with the set of results. I think it's a strong set of results. There's been a lot of work that's gone into this by the different management teams, and I just want to echo Werner and thank them for their hard work. So let's get into a bit more detail here. I think overall, the improved performance, our increased cash generation, the strong balance sheet that we've got has resulted in this dividend payout ratio that Werner mentioned earlier. We increased that payout to 50% of headline earnings from continuing operations. That was done at the half year, so our interim dividend increased 56% to 25 cents, and the final dividend that we've declared of 33 cents is up 74% on the prior year. If we look at our revenue base, so we've highlighted this at interim. FY24 was a year for us of fixing this business, streamlining it, refocusing the base. We've closed and we've restructured some non-profitable businesses so that we make sure that we have a core base now that's capable of growing both revenue and profit. So if you consider this, and I think it's well aware that it's a tough trading condition or trading environment out there, I think the 8% revenue growth that we've achieved on a like-for-like basis is quite a pleasing result. This was led by Arrow, 18% revenue growth, and then Netstar, 12% revenue growth, respectively. What's even more pleasing for me is that we've managed to grow our annuity revenue across the group to 9%, and that now contributes 61% of group revenue. On a statutory basis, we've seen a 2% decline in revenue, and that is the effect of the ATM business being in for only 4 months versus 12 months in the prior year. If we look at our operating expenses, these increased year on year, driven by planned investments that we've made in our people, our brand, sales. These are all focused investments to drive growth going forward. Some of these were once-off, and we've indicated them on the slide for you. If you exclude the once-off costs, our operating expenses increased in line with inflation. With regards to our real estate consolidation project, those targeted cost reductions, we will reinvest in growth going forward. The positive cash flow impact of that real estate project is that we're going to gain 500 million rand in cash over the next 9 years until the end of that lease, which is obviously money that we can spend a lot better in other areas. If we now move to operating profit, so in the operational review, Werner was focused on EBITDA, and that grew 27%, and that was really underpinned by that strong recovery in ASI and also on the Netstar side of the business. I'm going to focus on operating profit. Just to point out, this operating profit once again benefited from a fair value adjustment on our defined pension plan, 35 million. We had a similar adjustment in the prior year. We stripped this out because we have no influence over this. So what we show you is the operating profit results of the businesses that we manage. So we've also taken out the ATM business here that I've discussed previously. So all of our segments recorded operating profit growth. They delivered an increase of 174 million rand or 33% year on year. Digital transformation grew operating profit more than 100% to 195 million, and that's on the back of ASI's successful profit implementation strategy. That turned from a loss of 20 million in the prior year to a profit of 87 million rand in the current year. If we look at our own platforms, that generated operating profit of 613 million. That's up 18% on last year. And that was largely underpinned by FinTech. They grew operating profit 24%, and then Netstar delivered 16% operating profit growth. I just want to once again remind everybody on Netstar, we accelerate our depreciation of our tracking devices. We do this over a 3-year period. Most of our peers depreciate over a longer period, 5 to 8 years. And then in addition to that, Netstar is currently also in an investment cycle, particularly upgrading its systems to be able to manage this growth that the business is delivering, and that has also led to an increase in depreciation. Once again, if we exclude the ATM business, managed services grew its operating profit 36 million, and that's up 6% on the prior year. And then Arrow, on the back of its strong revenue performance, the strict cost controls, the margin expansion, that resulted in operating profit of 67 million, up 34%. I mean, I'm very pleased with the results of the core business. This revenue growth out of our continuing operations, the profit improvement strategy taking effect, and the operating leverage coming through has delivered this set of results. That grew headline earnings and headline earnings per share from continuing operations 36%, earnings per share up 46%. What's really pleasing for me is if you look at the business performance on the first half versus the second half, you can see the impact of these results coming through and growing now, and this is a pleasing result. If we look at our CapEx expenditure, so we invested 567 million in CapEx. Of that, 463 million relates to growth CapEx. So this is predominantly focused on capital rental devices in Netstar, 328 million rand, and then Altron FinTech, another 21 million rand. On top of that, we invested 92 million rand in our systems and our platforms, and that's to support the growth and improve user experience across the business. As we continue to grow both Netstar and FinTech, this investment in capital rental devices will continue to increase to support the growth out of those businesses, and that, along with the increased returns as our infrastructure business grows a customer base. So what's important for me on this is we are investing behind growth, and that's for me where the money should be going to. If we look at our group working capital, we've done a lot of work. The teams have worked very hard across the group to focus on our working capital and to really narrow it down to a base that we can now use going forward. Just something I want to point out. So you'll note that we have now reconsidered the inclusion of contract liabilities in our working capital. These contract liabilities have got a lifetime of more than 12 months. And what we want to do is we want to get to working capital that recycles in a 12-month period. So we have excluded it from the opening base to get to the right starting point. So you'll note that as reported, our working capital was 1.2. We've excluded this, so our starting base for working capital is 2 billion. That decreased to 1.4 billion at the end of the year. 152 million in cash was released from working capital, and then another 400 million, which was attributed to the non-cash adjustments out of our discontinued operations. And that's overall led to the 552 million reduction in working capital. I think this new base now is a base that we can use to grow the business. It heightens the focus on our working capital, but we will continue to work on this with the business units to optimize this. If we look at our group cash flows, cash generated from operations up 25% to 1.6 billion. Our tax increased to 131 million. This was driven mainly by a change in tax legislation around the utilization of assessed losses. That is now limited. That in the past you could use all of it. Under lease and other payments, that increased to 743 million from 357 million in the previous year. What is in there is a repayment on our revolving credit facilities of 425 million rand. So that for me is been a focus, and if we have the capital, I would like to bring that debt down. Dividends during the year, 170 million, and I think if you look at this slide from an operational cash flow perspective and then towards our capital allocation, you will see that in our capital allocation we talk about growth capex to support the growth, and then the funds that we've returned to shareholders on the back of this performance. So this strong cash generation, the higher cash balances, that gave us the flexibility to reduce our group debt. That led to a 15% or 18 million rand reduction in net interest expense for the period. Our debt decreased from 563 million to 313 million at the end of the year. And then for purposes of our covenants, we had used an adjusted net debt calculation. And after that, it actually infers that we ended the year in a net cash position, which is the negative ratio that you see there of 0.09. These covenant ratios are well within terms, and it gives us the flexibility to execute on the strategy that Werner has laid out for you. So that's it from me. Werner, can I hand over to you for the outlook?
Thanks, Carl. I pushed the wrong button a lot yesterday, which turns the screen off. So I wanted to really focus and make sure that I push the right button. So as we close and we look forward, I just wanted to give you folks, you've seen our strategy and what we focus on. I just wanted to give you a bit of a sense of how we look at the business from a short, medium, and long-term perspective. We call it Horizon 1, Horizon 2, and Horizon 3. Horizon 1 was really around foundational growth. So that really was around setting a clear strategy for the business. It was really about revitalizing our people, embedding this customer obsession, launching our purpose. Then we invested significantly in core capabilities to drive the business. And as you saw, also adding to some of our leadership team that have got extensive experience in managing the business, we've also added some new people. Carl coming in as CFO, Grant coming in as the MD of Netstar, Craig Stewart, who's running our Altron digital business, Marissa, who's doing our marketing, and of course, most recently, I'm trying to find him in the audience, Dr. Andy Mabaso, who's joined us as Chief Technology Officer, really to help drive that transformative growth. We then looked at all of our different businesses, did a deep dive, and established target operating models for all of those businesses. Coming out of that, we saw the need to have to drive profit improvement strategies in the short term, particularly in our Netstar and in our ASI business, and we also had to take some strong corrective action in ADS and Nexus, and really manage those businesses for value during the disposal process. Now, as we stand here today, about 12 weeks into what we call Horizon 2 or accelerated growth. And now that really is about, we've launched our Altron digital business. Hopefully you've seen that on the 1st of March, really revitalizing our brand. We've launched a long-term incentive scheme for our management that really drives and aligns them with these targets and with and with shareholders. And of course, we'll continue to manage ADS and Nexus for value during the disposal process. So now for us, it's about executing. We've spoken quite a lot about some of the investments we've made in growth, in brand, and in people, and we now want to make sure that that pays off and we got some accelerated growth. The way we look at our transformative growth, as I mentioned earlier on, that's really around our capital allocation and how that informs the continued growth investments we make, whether it's in our platforms, whether it's in targeted M&A, and whether that is really just using data and AI more effectively. And I think you saw a couple of examples today of how we do that. And if we execute on all of this, we are reaffirming our guidance here that we believe our platforms business segment should deliver about 19% operating profit margin. With Netstar's profit improvement strategy, we're targeting an operating profit margin of 16% in the medium term. IT services, as you can see there, significant improvements in the profit margins in that business, and we are targeting a 6 to 8% operating profit margin in the medium term. And overall, reaffirming our target of tripling our 2021 continuing operations profit of 371 million to 1.1 billion by 2026. Thank you very much for this first part of the presentation and for listening it. I think there's going to be a short video playing right now, which I think is really exciting. It's going to tell you a little bit more about some of the stuff that our fintech business is doing, enabling Lefa Cash Loans, one of our customers. And then I think Carl, myself, and Bron will go to the galleys and be ready for you to ask us any questions. Thank you very much for listening so far.
Actually, it was my wish since growing up to be an entrepreneur. My name is Lefa Tsolwane. I registered this business 2020. Yes, then I started operating in this office in 2021. I'm offering small loans, not bigger amounts. I'm working with pensioners here and people with disability and SASA people.
NewPay provides a payment solution system. By this system, we just, promoting all our customers to collect safely and also quickly.
NewPay is helping me with a lot of things. It makes my work very simple. It makes my business run smooth because everything is recorded on the system. Debiting, creating loans, checking people, doing an ITC.
Altron FinTech is big on small businesses and equipping them with the right tools to actually grow. We live in a country whereby it's still developing and people are unemployed. So when they do want to grow the economy and start a business, that's also them trying to create jobs out there for the surrounding areas and their communities that they're actually operating around. I'm talking about individuals or merchants out there who have started by themselves, but now they have about 6, 7 employees. Before they were unemployed. And they're utilizing this system because now the owner cannot only focus on one thing because you also want to expand or grow their business. And they're opening branches because it's growing massively. It's out of this world. And they also get excited because they know that they're actually doing good and they are self-employed and self-made as well.
And my wish is that even when I'm old, my company keeps operating. Yes, that legacy. That's my wish.
That is true financial inclusion. Carl, do you think that this now excludes you? Sorry, did Vanna terrify you?
I don't know.
We are live and we're taking this Q&A. I'm very glad I could get the FD to come up and join me. Just to highlight again, please, if you are watching online, you can post your questions in the online chat and in the room. We have roving mics on each side of the room. So just put up your hand and we will deploy a microphone accordingly. Let's start with the digital transformation that we're seeing with regards to Altron digital business. It happened in March in terms of the integration of 3 different businesses, Carabiner, Altron Systems Integration, and Managed Services. Are you happy with the progress, and is there any chance that you could disrupt the frontline, Vanna? When I say frontline, you know I'm talking about sales teams in terms of integration.
Look, Bronwyn, I'm never happy, but I think we've hit the milestones that we wanted to hit. We committed that we'll get that done by 1st of March, internally and externally. We've done that. All the work with the sales teams have been done. So, so far, so good.
Carl, working capital down over $500 million. Is this now a normalized level?
Yeah, Bronwyn, the teams have done a lot of work on this, and to get us to a base where movements in working capital should be reflective of the growth in the business. That's we'll obviously always continue to keep our eye on it, and there will always be tweaks in where we can improve. But my expectation is that is the relationship we're going to see, working capital to growth.
Altron Security. You mentioned you are slightly disappointed, although it is off a high base and it is a sweet spot in the South African environment. Are you enthusiastic about security going forward?
Yeah, I'm very enthusiastic. I mean, that market is still going double digit. It's top of mind for all, CEOs, CFOs, CISOs, CIOs. I think it's just upon us to take corrective action and fix the performance of the business.
Coming through from Charles de Villiers, please can you provide an update on the disposal processes for the non-core divisions? Vanna, if you can take that, and Carl, if you want to add.
Look, these processes unfortunately are subject to non-disclosure agreements. So, we are actively working on it, but I can't unfortunately give a detailed update.
Questions from the room, again reminding you that we do have David Fraser. I see you, sir. Thank you very much.
First of all, congratulations on a good set of results and a nice sort of strategic refresh going forward. I guess the one business that doesn't seem to fit in the strategy is obviously Arrow. Now, when businesses perform well, all of a sudden they're core and strategic. But when I look at the elements of the other businesses, it certainly doesn't fit into that. It's sort of an old economy. It's a component distributor. It's part of the old legacy manufacturing business. I mean, maybe just talk a little bit about Arrow. Does it fit going forward, or is it fitting because it's performing, or strategically, are there any sort of question marks on Arrow going forward? Could it be non-core?
We haven't really relooked that decision at this point in time. We see it as part of the business. I mean, there are some overlaps between that and our IT services business. Some good synergies that we're getting there in what we call our ECS, which is the Enterprise Computing Solutions business. But no, right now we're happy with that business. We're not really looking to revisit the decision at this point in time.
Strong balance sheet. And Carl, if you can come in here, do you feel under pressure now to go about corporate activity?
No. Bronwyn, we have to look after this business, and we have to look after the assets of this business, and we have to create value for shareholders. But value creation doesn't necessarily mean jumping to an acquisition. We have businesses where there's a lot of opportunities to expand what they do, and then we would look at some bolt-on type acquisitions just to make those businesses more robust, add more to them. But we are certainly not under any pressure to make any acquisitions.
Given the current landscape when it comes to health in South Africa, Altron Health Tech possibly very well positioned to take advantage of that administrative burden. Vanna?
Yeah, I think so. We obviously all saw President Ramaphosa sign the NHI bill into law on Wednesday, and obviously some of all the subsequent news around that. I do think it represents a potential growth opportunity for us, Bronwyn. We strategically and intentionally pivoted that business, I think about 3 or 4 years ago, out of just that core private practice. I mean, you've already seen some of the growth, and what we've now got is a platform that scales and a platform that manages that whole value chain. So I don't think anybody quite knows how NHI is going to play out at this point in time, but yeah, I think it could be a potential growth opportunity for us.
Just turning to this side of the room again, please just indicate if you do have questions. Carl, the proverbial question for the CFO, what keeps you awake at night, sir?
We just to say that we are very fortunate to sit here today. The situation that we're in, having a strong balance sheet, that's a very fortunate position to be in, but those things can change overnight. We are in a constrained economy. Our customers are feeling the pinch, and ultimately it will flow through the whole economy. So I think with the upcoming elections, there is some uncertainty, and so I think we just need to be wide awake and look out for opportunities, but also look out for things that can disrupt us.
And Van, I want you to add to that outlook. Carl mentioning the elections, we are in a low growth scenario. How do you feel about the general operating environment going forward? It's not easy.
It's definitely not easy. I mean, it's very tough trading conditions. I think where we're really fortunate is that the businesses that we have are firstly in high growth markets, right? I mean, the telematics segment, the fintech segment, the health tech segment, security, we spoke about that. So I think we're really privileged to be able to do that. And, now we've got to really focus, even in high growth segments like we saw in security, if things go wrong, they can go wrong. But we're really focusing on making sure that we capitalize on the opportunities that we've got in those segments, and to be able to continue to deliver these kind of results. But trading's tough, it is a challenging trading environment.
Costs coming out of the business, is there room for more from an efficiency perspective, Carl?
Bronwyn, yes, but I think there's two parts to that. Efficiencies, we're always looking for them, similar to our working capital, our cost structure, but we are going to invest in growth. We're going to invest behind our people, and we're going to invest behind our products, and because there is an opportunity for us to grow, and as long as our cash goes towards investment, then I'm happy with that.
Go ahead, sir.
Thanks for the opportunity to ask questions. Vio Kopisa from Prescient Securities. 2 questions. On Netstar, how much of that enterprise growth, subscriber growth, came from benefiting of what's happening with Transnet and there being more traffic on the N4 because you're importing goods through Mozambique? And then the second question that I have is, please highlight for us again, in what ways is the Global Fleet Bureau similar to your peers, and how is it different to your peers? That's it for me. Thanks.
Thanks. I'm not sure that we're necessarily benefiting in enterprise growth from the increased traffic because of the lack of the rail infrastructure. I mean, some of those customers, of course, are growing, so I think we're probably benefiting from some of that growth. But I'd like to think most of that growth has been on the back of customer acquisition. But I understand where you're coming from in terms of it growing their businesses, but I wouldn't directly attribute our growth from that, but it certainly represents an opportunity, right, for the segment overall. Secondly, I was going to say tongue-in-cheek, I'm not going to tell you our Fleet Bureau is the same as our competitors, but I certainly think the artificial intelligence that we built into the system, and I think the platform capabilities, gives us significant, scalabilities that I'm not aware. As I said, it is the most technologically advanced, and to our knowledge, the biggest in the continent. What's really good about this Fleet Bureau is the technology is also exportable, right? So we can also use this in our Australian business.
You talked to foundational growth, accelerated growth, and then the transformative growth. You said that you've completed the foundational growth. How long are you going to be in the accelerated growth, or Horizon 2, as you refer to it? How long will you be in this phase?
So 2 years. So the kind of way we looked at it as Horizon 1 was that we wanted to have a fanatical 1-year focus on fixing repositioning. So for us, Horizon 2 really extends to the 2026 medium term, where we gave some guidance. Horizon 3 goes into 2028. Having said that, remember that they move out. So your kind of, your Horizon 2 becomes your Horizon 1, if that makes any sense. But from a simplistic perspective, 2026 for Horizon 2 and 2028 for Horizon 3.
Gentlemen, thank you very much. We've got no more questions online. That generally means a job well done. You've answered the questions in the presentation. I see a lot of acknowledgement happening in the audience to that effect. Thank you very much, Van Kapp, Carl Snyman, and good luck with the rest of your day. And thank you so much to our live audience and also to the audience joining us online for the Altron annual results.